Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He says the senior indices are seeing money move to the junior markets like the Russell 2000. The big story was the collapse in gold and silver. Ross checks out copper, crude, and Bitcoin. Veteran trader Victor Adair, website victoradair.ca, gives us his opinion about why gold had a roughly 16% drop in value and silver around 37%. He also looks at the Toronto Exchange's 5% correction and tells us if he's worried about that or not. He also checks out Currencies and the effect of President Trump's Cuba oil embargo. Victor also talks about his presentation at the World Outlook Financial Conference in Vancouver. Also at that conference will be Martin Straith, founder of thetrendletter.com. He gives us his outlook for gold, silver, and what President Trump's pick for heading the Fed might do to the U.S. dollar and the stock markets. He examines what's happening with Bitcoin and the world of decentralized financing. Martin also has a special offer for our listeners. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Another big week, Jim, and this one was more so in the non-equity markets. It was over in the commodity side of the equation. But for now, if we take a look at equities, we've still got that November or October peak as far as the S&P and the NASDAQ are concerned. And during the week, the Russell 2000, the small cap index, and the unweighted S&P eked out a new all-time high. So there's still that big rotation going on. You know, if we take a look at the mining index of stocks, and we take a look at the XLE as far as the energies are concerned, you know, that's where the money is moving to right now. And coming out of things, you know, such as the Mag 7, there's a lot of money over there, and if it starts to rotate, these other groups can do famously, because on a long-term basis, looking at the weighting in the equity markets, they are very small now relative to what they have been. Whereas, as far as the other groups that we've had hot on the upside for the last year and a half, they are so overweight that as the money comes out, hopefully it finds other homes.
Now, the big shocker of the week, no doubt, the gold and silver markets.
Oh, yeah. Gold target had been right up here. We managed during the week to get through our upside target that we had established back in December. You know, we took a look at that consolidation pattern, and the upside action was counting up to what we had. The last 4 days of the move, clearly producing a lot of upside exhaustion alerts in our indicators. And then over in silver, going back to last spring when we got that breakout at 35, and that was on our relative strength index, the indication there is what we had two major target lines for resistance, one at 75 and one at 125. And we weren't getting overbought as we moved to 75, so the 125 was the optimum target, and just came within $4 of that this week. So, you know, once you have that exponential move, when everybody's on board and that's all they want to talk about, as soon as there's a reversal, it becomes hot and heavy. So for silver, the move right now, hard down. We're down, a huge amount during the week, and it puts us into an oversold category. So there's a chance of pretty good bounce back next week. On the gold market, our target for corrections after you've had runs like this is the 30-day exponential moving average. We saw that in the last few years here when we've had big upside moves. You take a look back to 1979 and 1980 when there were the big moves. The initial corrections in gold was back to that 30-day moving average. And from there, you get a good 50% retracement rally. And as of Friday, we got down to the 30-day average. So the chances of a pretty good bounce here and consolidation in the coming week or so really looks high as far as our analysis is right now.
What's going on with copper?
Copper has it popped up during the week, and like the other markets, came back. We did have that spike high up to just shy of 660 on the futures contract. Closed back at 595, but the movement there has been good. And if we look at the mining stocks, the gold stocks and copper stocks had been the best in terms of price action on the upside since the May turnaround, and have done exceptionally well. Silver stocks have been the worst performer of the group, and at this point, I think that the undervalued moves or action that we've seen in silver may see some good upside. But when we take a look at the copper market and the price action there, I think you've got a chance for an excellent run in terms of the price. If it can manage to hold through the 580 range, which had been the support in the last couple of weeks, I think you've got big upside. And there's no question that, copper may be an alternative to some of what's going on in the silver market. And the copper stocks, as I say, doing well with gold, and there's a lot of upside potential there.
What's going on with crude?
Crude, a really good bounce back in the last couple of weeks. Unexpected for me. I was looking for a seasonal low and a turnaround. This one came fairly strong. We got up to $65, up from the low of $55 just 3 weeks ago now. Got some good overbought readings as of the end of this week. So I think even though this might be in its best seasonal period, there's a chance for a pretty good pullback right now.
What's going on with the U.S. dollar?
U.S. dollar got hammered into the early part of this week. We got some great oversold readings right into the lows, just around 96 on the dollar index. Some of the big bears out there are looking at the trend lines coming up from the last 10 years and saying, wow, it's broken. It's just going to hell in a handbasket. But from our perspective, really, this is in a trading range that we've seen since 2014. And we're now in the bottom third of that range with some good oversold readings. So I think the dollar index can bounce back pretty well. The Canadian dollar, we like to look at the action there relative to the U.S., and it had an exceptionally good rally from 72 up to 74.40 as U.S. dollar was moving to its lows. And with the reversal in the dollar index, we're seeing the Canadian dollar start to give up ground again. So I think you start to think about levels back in the 70 2.5 range.
What's going on with Bitcoin?
Bitcoin had its initial move off the lows here. What was that? A couple of weeks ago, we peaked at 96, just over 96,000. Had our minimum upside move based upon the consolidation pattern since December, but given up ground. This one right back down to the lows of the last couple of months. It looks like it's got more potential on the downside. So time to step aside and look for the potential of a new base at lower levels, clearly into the 76,000 level or lower.
Ross, thank you so much for being on This Week in Money.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on X at Charts by Ross. Coming up, Victor Adair, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Victor Adair, recently retired from nearly 50 years of being in the brokerage business in British Columbia, but he's still very active in the markets. He's speaking to us from beautiful Parksville on Vancouver Island. His website, victoradair.ca. Welcome back to This Week in Money.
Jim, it's always a pleasure to be on with you. Thank you.
Precious metals were hitting new highs, and then all of a sudden somebody pulled the plug, it seems, on them on Thursday. And Friday, another bloodbath. What's going on there?
Well, I mean, to put some numbers on it, I think the drop in gold from Thursday's overnight high to Friday's lows was about $900. That's about 16%. Silver, kind of similar. I think silver prices fell from, again, the highs overnight on Thursday to Friday's lows, about $45 an ounce. That'd be about 37% down from the highs. So a very dramatic break in so many ways. I tell you, this reminds me of January 1980 when the gold price had hit $850 and silver had hit $50. And then the prices just collapsed very, very sharply. What's going on? I mean, a lot of things. Clearly, we've had an incredible run to the upside in the precious metals. You know, it seems like silver, it was just a couple of months ago, it was trading at $30, and now it's, it hit $120. I did write a piece in my trading desk notes this last week or the week before, whatever. My view was, I don't know why gold and silver have gone vertical like this. And this goes to the heart of how I manage risk in the markets. I don't pretend, try to fool myself that I know what's going on. I mean, I'll have some opinions. It's hard to not have. I'll have some hunches and gut feelings and all that sort of stuff. But at the end of the day, I know I don't know. So, it looked like, and yes, it was this past week, because I put some other charts up. I said, this reminds me of some of the commodity market spikes we've seen in the past. For instance, gold and silver back, whatever that was, 45 years ago, or crude oil in 2007, 2008, when the price tripled and then broke sharply. And what that might mean then is that we just had a speculative piling on people using more and more leverage, and the more it went up, the more they knew they were right, and it could never be wrong, and get me some more. You just can't have enough on, when the market is running in your favor. And then, boom, the old rug pull. What triggered the rug pull? It doesn't matter. I mean, some people are saying it was because President Trump is nominating Kevin Warsh to be the new head of the Fed. That's sort of a hawkish surprise. But clearly, this is a market that was overdue, to say the least, for at least a correction. And by the way, while I'm on it, Ross Clark, as some people may know, Ross Clark and I have been friends since the late 1970s. when we worked together at Conti Commodities in Vancouver. I have had just huge respect for the technical analysis that Ross has done for all those years. And Ross, to his credit, put out a pretty clear warning on both gold and silver this week, just saying on the basis of the technical analysis that he does, these markets have had a run and are set up, this is my language, not his, are set up for a reversal. So hats off to Ross for a really great call here on what happened in the precious metals this week. Now, where do we go from here? I'm going to stick to my I don't know story. The hardcore believers are just going to say, okay, now we shook out the weak hands, and now we're going to take gold up to 10,000 an ounce or whatever. Okay, I mean, you can't talk to those guys. That's what they believe. That's what they believe. I'm not saying they're right or wrong. I don't think that way. I have not traded gold or silver from my own account for the past, 2 months anyway, just because the first and foremost thing that I do with my trading is try to manage risk, and I just couldn't see where I could put a position on in those markets and manage the risk on it. So I managed to make some money trading other markets that, compared to the volatility in gold and silver, looked like they were doing nothing. But anyway, that's me. If I can't manage the risk on something, I'm not in.
Now, the Bloomberg Commodity Index hit a 4-year high. Does that mean other things are going to have a sharp correction?
Yeah. Well, okay. Let me answer that this way. I think what I've seen here increasingly over the past year and more, certainly as the stock markets rallied from the lows of last April, where, like across assets, speculators were piling in or buying more and more aggressively, using more leverage any which way they could. So I think everything here is over-levered and at risk of stepping on a banana peel. Now, not directly, the Bloomberg commodity indices and some of the other ones have been rising. Certainly a 4-year high makes sense because the metals have been a big part of that increase, of course. But then things like crude oil have been pricking up as well. And now, not all the commodities up for that's for sure. But yeah, does it indicate that other markets are at risk of a slide? I think that could happen just because of the over leverage that's been built up when markets have been going up and up and up, and people think they never go down.
Yes, and then you have the margin clerks giving you a call.
Well,
or sending an email.
I'm going to be writing my weekly trading desk notes here, and I think my headline for this week's edition will be margin call.
Now, the TSE index had its sharpest 2-day drop since April 2025. And yes, when I turned on Bloomberg television today, everything was outlined in red. That's never good.
Well, let me tell you something. The Toronto Stock Index, you're right, it's the sharpest 2-day drop we've had since April of last year. And for people that, it doesn't click automatically, that's when Trump announced his tariffs on virtually everybody, and the market just tanked. The market, I guess, from Thursday's highs to Friday's lows, the TSE was off about 5%. Okay, it's not the end of the world, but it's like for the market that had just been grinding steadily higher from the April lows, and even, say, in the period of November, December, when the American markets were near their highs but kind of going sideways, the Toronto market kept marching higher. I think the Toronto market was really goosed by the commodity space, the mining, whether it's, uranium, copper, gold, silver, what have you. I think that was a big part of the rally in the TSE. So with gold and silver getting whacked today the way they were, and just for perspective, the gold mining shares really had a tumble today, and they've been looking a little toppy as well here the past couple of days. But with gold and silver down, they were down. So yeah, a sharp down on the TSX, and no surprise given what happened in the metals.
The U.S. dollar index hitting a 4-year low. What's the story there?
Let's take that in a couple of pieces. There has been, what did I call it? I call it Trump fatigue in my trading desk notes a couple of weeks ago, where, after just so much of the drama of his, the unorthodox methodology and so on, that people outside of the USA might have been thinking, something, gosh, the American stock market has really outperformed the rest of the world like crazy, for the past 15 years or so. I've done really well, but, the last year, if I'm a European, the gains I've made in the broad S&P, say, I'm up maybe 2% because you got to factor in the weakness in the dollar and so on. It's maybe I'll just take my money or some of my money out of the United States and put it in someplace else. Like it might go into emerging markets, or it might go into the ultra safety of putting it in Switzerland. So I think there was a lot of, the commentariat, the analyst types were chattering about people getting a little tired with their American investments. So what do? You could either sell your investments, or what I think was also happening was hedge your foreign exchange exposure. So you could see the stock market not falling because people weren't selling their stock, but you could see the U.S. dollar falling maybe because foreigners at the margin were selling U.S. dollars to hedge their exposure with the investments that they continue to hold. So that's one thought on it. And then as the dollar started to go, and by the way, and currencies have just been dull as dishwater here for the last 6 months or so, and finally, they're perking up. So people started jumping on the trade. We had the euro and the British pound both rallied up, if you can believe it, 5-year highs against the U.S. dollar, and I just shake my head thinking, oh my God, the euro and the British pound, people are aggressively buying that against the U.S. dollar? Man, they must be really upset with Trump. So that was, you're saying, the dollar's like that. And then, I know what I was going to say, Trump, what was it, on Tuesday, as the U.S. dollar is kind of picking up momentum to the downside, the currency market's perking up for the first time in months, and somebody said, are you worried about the U.S. dollar falling? I said, no, it looks fine to me. Honestly, that was like within 10 minutes of the U.S. dollar turning around and starting to go back up again. It's amazing how markets work that way. And when I say go back up again, I mean it's up maybe 1% from the 4-year lows that it had hit on Tuesday. But yeah, the U.S. dollar got a little more bid, and then with gold and silver going down, the U.S. dollar maybe did a little better as well.
The Canadian dollar rallied over 2 cents to a 15-month high. What's going on there?
So, as I've said many times talking with you, the Canadian dollar often is like the little brother, okay, that just follows around the older brothers, the euro and the British pound and the Japanese yen and the Swiss franc, whatever. So there's a lot of that. If it's said this way, if most of the major currencies are going down against the U.S. dollar, so is the Canadian dollar, and vice versa if they're going up. So there's that. And with the U.S. dollar being as weak as it was, Canada was going up a bit. The other side of it, of course, is Canada, from time to time, has a correlation with commodities, and particularly with crude oil. Now, there's other times when they're going in opposite directions, so it's not a 100% fair deal. But with crude oil prices lifting, I mean, we're $55 in December was the low on WTI and the NYMEX exchange. That was a 4-year low, thinking off the top of my head. We hit $66 this week. And certainly part of that is, the American military assets moving closer around Iran. There's the talk going back and forth. Who knows what's going to happen? So that puts a bid in crude. And then positioning when the market was down at $55. It had been trending lower. Actually, you go all the way back to 2022 when we're up at $130 when the Russians, following the Russian invasion of Ukraine. So crude oil had been trending down for a long time. Clearly, there were speculative short positions in there, and when the market turned higher, crude kind of got a little extra kick to the upside. So Canada rallying on certainly the precious metals, and people looking where do you buy gold, silver mining companies? You look to the Toronto market. No matter if you're in Hong Kong, that's where you're going to look to put your money. Canadian dollar's up because the U.S. dollar's down against everything. And then the other kicker was commodity prices are bid, so the Canadian dollar's up. Now, that was 2 cents on the Canadian dollar. The Australian dollar in that same period of time was up 4 cents. So these are both, we talked about them as being commodity currency, but the Aussie dollar got an even bigger kick to the upside. So I think that's part and parcel of why we saw the Canadian dollar rally to, as you were saying, about a 15-month high.
Yeah, so I think the Aussie dollar going up because they just made a multi-trillion-dollar iron ore discovery.
That wouldn't hurt.
That
and
sure
actually, you're reminding me, Aussie, their economy is kicking along pretty good, and it looks like when the Reserve Bank of Australia meets again, and I think they meet this coming week, they might be increasing interest rates, where most everybody else has been, like Canada, the United States, have been cutting rates. But I didn't know about this zillion-dollar iron ore deposit. Okay.
Yes, and Bob Hoy has pointed out several times in his show here on House Street that so many people want lower interest rates, but he says when interest rates are going down historically, that means you're headed towards a recession. He said in good times they go up, so good news for Aussie land.
Yep.
Now, the S&P 500 index hit a record high above 7,000 on Wednesday, but weakened slightly amid quarterly corporate reports.
Yes. It, as I said a few minutes ago, the S&P was up around all-time highs, I think, going back to, say, November, December, and into January. Maybe we'll make a new high, maybe we don't, but it's been kind of going broadly sideways here for about 3 months at around all-time highs. It just seems to be, and we've talked before about this. There's been this rotation in the market. Clearly, for the past couple of years, the Magnificent Seven or the big cap tech stocks were leading everything to the upside. We just had a period here of a week or two where the Russell 2000 was running ahead of the Nasdaq for the first time in forever. But overall, when I look at the S&P, and by the way, for me, I use the S&P as my risk barometer for the world. I mean, it is just the most important market in the world. And some guys in the bond market would argue with me on that, but that's what I look at when I want to know, is the market risk on or risk off? And the S&P here has been sort of going sideways for 3 months at all-time highs. Again, I wrote in my trading notes this past week, we're in the heart of the quarterly reporting season. We had, 3 of the big tech companies report this week, and over the next couple of weeks, like the big guys in the S&P 500 are going to be reporting. And here's the thing with the quarterly reports. A whole bunch of analysts guess what they're going to be, all the different metrics that they look at, and then the companies come out and they beat the expectations. It's like, yeah, I'm shocked. It happens all the time. If we have really good, strong earnings, and by the way, the correlation between the company's earnings and the prices of the stock, either at the individual level or at the whole index, are highly correlated. So the market is being driven largely at the academic level by earnings. So if the reports show strong earnings to date and expectations of continuing strong earnings, like right now, all of the leading analysts on Wall Street are saying the S&P is going higher again this year. Okay, so if we get through corporate earnings season here and the earnings reports have all just been as expected, are likely better, and the market doesn't go up, I think, if you're a portfolio manager, you got to scratch your head and say, maybe we ought to lighten up on some of that stuff we got. We'll see.
Now, for a while, crude was crud, but after hitting a 4-year low of $55 in December, WTI rallied to a 6-month high of $66. Roughly, why?
Well, we talked about that a few minutes ago. The price had been $130 when Russia invaded Ukraine. It's trended lower since then. I'd say certainly over the last half of 2025, the bottom line narrative was that there was more supply than there was demand. And that was just putting increasing pressure on the market. I think in some respects that's still the case, but in that 6-month period we had a relatively, and I use that word in quotation marks, benign geopolitical environment that was after there had been the brief war between Israel and Iran, and the United States got involved. Certainly the Ukraine war grinds on, and it keeps looking like maybe, they could do a deal, but it's still there, so sanctions and all that. But still, the big picture, supply seems to be outrunning demand. Prices are low. Some production may get not made or shut in or what have you. The idea that there was going to be a bunch of crude come out of Venezuela in a hurry, I think any serious folks said not a chance. That's just a disaster there. They're down to 500,000 barrels a day of production, and that's not going to increase a lot anytime soon. But to answer your question, sorry for getting rambly there, the U.S. military buildup around Iran, I think that's got a hell of a lot to do with the fact that we're trading at $66 instead of $56. And how do you deal with that? You could wake up tomorrow morning and find out while you were asleep, the American military moved on Iran, and now we're in a hot war, or not, maybe whatever. So I think the uncertainty there. Anybody who is short would say, we've had a nice run on the short side here. I think I'm just going to get out of my short position.
A Trump oil embargo is starving Cuba. What are the consequences of that?
That's I'm going to write about that in my blog this week. I've been thinking about that. It's been really, really difficult to get any kind of accurate numbers on how much crude Cuba produces themselves, how much they were getting from Venezuela and Mexico, which were their two other sources, and the occasional load come in from somewhere else. But at the margin, that was the basic picture, and it's bizarre because usually I can get some pretty accurate information on how much oil is up, here or there. But the long and short of it is, there's no more oil coming to Cuba from Venezuela. And it looks like Mexico is not going to send any more because Trump said, don't. And we've got our military down there, and we're going to stop anybody from trying to deliver crude to Cuba. Cuba does not produce anywhere near enough. And they've got oil wells on the north part of the island and offshore north of the island. But whatever the numbers are, and they're struggling, I think. Production's down probably because, they can't maintain, they haven't got the parts, whatever. But the bottom line, they are not producing anywhere near enough crude on their own to feed the power plants that make the electricity. So they got, day after day, they got blackouts of power. And that's just going to increasingly become a problem. So where does it go from there? I mean, do they just say, okay, we give up, and we'll change? Or I don't know. I'm not going to pretend I know. But in the back of my mind, this is the bigger picture thing. If Russia and China look at what America is doing in terms of, let's put it in coarse language, let's call it a territorial grab. And it could look like that to different people in the world, over Greenland, over Venezuela, over Cuba, and then investments. Like they're clearly, Americans are clearly helping Argentina out. And you got Trump talking about, Canada's the 51st state and all that. So, in terms of it's good for the goose, it's good for the gander. If Trump can do that, then then maybe it's easier for the Chinese to take Taiwan, or Russia to take more of eastern Ukraine, or, that kind of stuff. I think Cuba is really off the radar screen here because there's just so much else going on. But sometimes the off the radar stuff is, gets on the radar.
Now, you're going to be speaking at the World Outlook Conference at the Bayshore Hotel in Vancouver on February 6th and 7th. Can you give us a little look ahead at what you'll be chatting about?
Yeah, this is Mike Campbell's the Money Talks World Outlook Conference. I think we're pretty close to being in our 40th annual conference, and it's been my pleasure, my honor, honestly, to be a speaker at a lot of those conferences over the years. And this year, I am going to be the opening speaker on Friday afternoon. And what I'm going to talk about is all this risk I see in the market from people having a lot of leverage, maybe too much leverage, and how, let's say, if I could say it in a simple sentence, if you're a trader, do you want to make money, really, or do you want to be right? And I've just seen over the years, I was a broker for 45 years, and I saw a lot of people lose a lot of money. And believe me, the most common thing, when you boiled it right down, was that people would not take a loss. They bought something, it's gone up, and now they're pretty happy with it, and they think it's going to continue to go up, and now it starts to go down. And instead of saying, oh, it's going down, let's get out so we don't lose any money, or don't give away all the profits we've got, or whatever, they'll say, well, let's give it a few more days and see. I just know this thing's going to turn around. Or, what we need to do here? We need to buy more. Like, this is a bargain. Let's load it up, because I know I'm right. Now, I'm making it very simple, but that is the most common denominator to, on the road to the poorhouse, as it were. Yeah. I talk about that I make money because I'm really good at managing risk. I do not have a crystal ball. I don't pretend I do. I subscribe to a lot of services. I talk to a lot of people. I see a lot of people's comments on Twitter and wherever else. And when I see people talking about all the great calls they make, I just tune them out. You never want to overestimate the power of having been in the right place at the right time by accident. You think you knew what was driving the market higher? Well, you might have been right, and it just might have been something else entirely that took it higher, but you thought, you were the smart guy. And if you're that smart, you can do it again and again. So, yeah, I'm going to be talking about the most important thing you want to do. And by the way, this is my point of view. There's going to be some people who say, no, he doesn't know what he's talking about. But for me, the most important thing is you want to preserve your capital. And your capital is the money in your account and your sanity. And I have seen people devastated. Jimmy, I've had 2 friends commit suicide, for crying out loud, over just taking shocking losses in the market. It's a horrible thing, and I want to tell people that I think, risk management is a good idea. So that's what I'm going to be talking about.
Yes, if you don't, could have deadly consequences. Victor, thank you so much for being on This Week in Money, and I look forward to seeing you at the World Outlook Conference. Thanks, Jimmy. It's always a pleasure to be on with you. My guest has been Victor Adair. His website, victoradair.ca. Coming up, Martin Straith, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Martin Straith, founder of Trend News Online at thetrendletter.com. He's speaking to us from Coquitlam, BC, which is just east of Vancouver. Welcome back to This Week in Money.
Oh, good to talk to you, Jim. Always a pleasure.
Coming up on the weekend of February 6th and 7th, you'll be one of the speakers at the World Outlook Financial Conference in Vancouver at the Bayshore Hotel. Last year, you delivered a 100% win rate and an average return of over 90%, a pretty impressive result by any standards. You'll be extending a special offer to attendees with discounts ranging from 33 to 57% off regular rates. And good luck for you, our listeners. You also have access to those specials. Can you tell us how people can take advantage of this offer?
So this will be our 7th year at the conference. And as you say, we've added 1,000 last year. So, we've had a good string of success of picks at the conference over all of those years. But certainly last year was, that's top. That was 16 picks and 16 winners. And 9.7% was the lowest return, and 341% was the highest. So, for your listeners to get access to our special offers, all I have to do is just go to our website, The Trend Letter, so all one word, thetrendletter.com. And on the front page, we'll just put a logo up there, and you can click on that and get access.
Do you have a special prize for people?
Well, actually, at the conference, too, with Adair.Gold, what we do, every year we like to support different charities. So we'll be, this year, we're going to, there'll be a draw for a 10-ounce silver bar, and that will go, all the proceeds of that will go to Heads Up Guys. That's a mental health support for men. And then also half of it will go to Special Olympics. So it's a great cause. Last year, I think we raised close to $4,000. So hopefully people that are coming to the event, drop by our booth. We want to chat with you anyways. But also, join into the draw there and see if you can't win. Like last year's, when you think about it, we did a gold bar last year. Well, the price of gold's gone over double. So you'll have a pretty good collecting item here.
President Trump is nominating Kevin Warsh as the new Fed chair. What does that mean for the markets? Well,
we had a lot of action in the markets today. The action today sort of suggested that markets were not thrilled with the announcement. The S&P opened about $70 down, but it ended up, just look at it here, it's closed at 30 down. So it kind of calmed down a bit. I think the big thing here is that, Trump's goal obviously is he wants to have lower interest rates because he wants to boost the economy, even though the Fed only controls the very short-term rates. But Warsh is, he's stated previously that he does want lower rates, but he also wants to aggressively shrink the Fed's balance sheet. So he wants to bring in quantitative tightening. And he wants to return to the 2008 system where the Fed controls rates mainly through managing bank reserves, not from holding trillions of dollars of assets. So that's a big difference to what they did during COVID and stuff, where they ramped up their balance sheet to, I think it was over $9 trillion. So the risk for Trump here is, if you get shrinking balance sheet, that removes liquidity. So that, we're talking cash from the system. And that would mean fewer U.S. dollars in circulation and likely a higher dollar. So I think that Trump is so fixated on rate cuts that he's ignoring the fact that shrinking the balance sheet could actually cause a massive hit to the financial markets. So we'll see if Warsh follows through on his desire to shrink that balance sheet. I mean, think about it. If he does, and the markets revolt, are we going to see Trump, unleashing the same barrage of insults at Warsh that he's been pumping out at Powell for the last year? So I think it's going to be very interesting to see how all this plays out. I just think the key is, I think he's a much more calm, conservative Fed chair than I think the markets were expecting.
Gold and silver have gone parabolic, but over the last couple of days, they've sold off hard. What's behind the sudden reversal, and are we looking at a blow-off top?
Yeah, it's been a crazy 24 hours here. Like you say, I mean, I think everybody's pretty aware of the parabolic run we've seen with gold and then lately silver. But you're right. In the last 24 hours, it has been wild. We're talking like decades. We haven't seen anything like this in decades and decades. And in silver, you've never seen it. So, we had a major sell-off in both gold and silver. Gold yesterday, over just a little over an hour and a half, I think it was, it gyrated 10% in that period of time. And gold has now lost $2.5 trillion of market capitalization. So gold has dropped from 5,600, where it was yesterday, and down right now we're looking at, it's just under 4,900 today. So, and then silver, look at this. Silver it was 121.50 yesterday. Right now it's just about 83. So you're talking about silver is now down about 32% in 24 hours. So as you say, what happened? Well, first of all, both gold and silver were extremely overbought, so they were susceptible to a major cleansing. We've been warning our subscribers even last week, really start having an action plan. You've got some huge gains here. So you don't have to sell everything, but certainly look to rebalance your portfolios. So here we had a big correction. Then as we just discussed, Trump announced his selection for the Fed chair. Everybody was expecting this to be an ultra dovish chair, meaning somebody who is going to be aggressively cutting rates, and that would be weakening the U.S. dollar. But Trump's selection of Warsh, well, he's not as dovish as the other possible selections. So the logic in the market is, well, if he's not going to be as dovish as the market expects, that means that the U.S. dollar could be stronger than the market expects. And a stronger dollar means there's fewer dollars needed to buy gold, silver, and most anything else like commodities that are priced in the U.S. dollar. So it seems like quite a reaction. I think that, gold and silver were so overbought anyways. They were just waiting for something to trigger a correction, and this is what we got. So again, they were both overbought. They were in a parabolic moves higher, and that meant they were due for a breather. Well, this is what we're getting now. So there's a lot of leverage in gold and silver. And so what happened is once the flush started, once the selling started, then margin calls got kicked in, and then that just magnified the move down. So this announcement of new Fed, that was just a catalyst to trigger the sell-off. So then your question was, is this the top for gold and silver? I think it could be near term, but I think that would be really very positive long term. This move higher was getting so extreme, you just knew it had to end at some point. And I think that, again, that was so extreme. A consolidation here would allow both gold and silver kind of to re-energize and, get ready for the next leg up. So I think, hopefully we get a consolidation here. But, it's already sold off 10%. Silver's down 32%. So again, what I think you need to watch, initial support for gold will be about 4,600 and silver around 75. But long term, we totally remain very bullish for both. And again, the reasons are the same we've talked about for months and months and even years. You got the debasement trade, of course. Global debt is now approaching $350 trillion. And you got U.S. debt is closing in on $39 trillion. So in the U.S., $39 trillion of debt, that equals about $112,700 per person in the U.S. And it equals about $350,800 for every taxpayer. So again, and it's not just the U.S. Here in Canada, we have a similar problem. Japan, UK, all of Europe, they're all piling up these huge debts. And so then you get the printing press effect. So when the debts get too large, too high to pay back, well, central banks have to they step in and they buy their own government bonds. And how do they do that? Well, they create new money. So they devalue their currency. So ultimately what happens is people end up losing confidence in the government's ability to manage the debt. And then we get this flight to safety, and that's hard assets. And that's where gold and silver have done so well. Now, this is where we are today. No government has any intention of cutting back on their spending. So investors are looking for a safer place to put their money. And then that gives you gold, silver, other hard assets like commodities. The other big one that we've talked about before, the de-dollarization. So we've got central banks, especially those that are not friends of the West. So you got China, Russia, Iran, North Korea. They are aggressively shifting their reserves away from U.S. treasuries and into gold. So we're getting this dramatic correction here, and ultimately, I think it's going to provide a great buying opportunity for both gold and silver.
Now, what about the S&P 500? Has it also struggled for the last few days?
It has, and right now the S&P 500 is only up about $50 for the year. So similar to gold and silver, the announcement of the new Fed chair, it gave the markets a bit of a scare. Again, the markets love rate cuts. They get so excited about this a quarter percent point of a cut, and the markets go crazy. So anyways, this is what it is. So everyone's expecting Trump to select a puppet chair, somebody that's going to help him get what he wants. And what he wants is the Fed rate down to 1%. So, we've also got a big earnings week, especially for the tech stocks. So we saw a really interesting development, I think it was Tuesday or Wednesday, where we had both Microsoft and Meta reported their fourth quarter earnings. And both of them crushed earnings. They beat earnings dramatically. But the stocks had completely different price action due to the capital expenditure spending. So Microsoft stock, after its earnings announcement, the stock dropped 8%, where Meta stock went up 10% after their report. So this volatility is suggesting that the markets are getting concerned about the amount of spending these companies are doing, especially for AI and data centers. And the concern really is, will there be profits from all this spending? It's great you have all these earnings and stuff, but what's your bottom line here? Because if you're spending more than you're earning, that's not good for stocks. Another key factor right now is Trump's all over the news again. We have these very few calm periods where we don't hear from him, that we're hearing so much from him now. He's threatening Iran. He's got a flotilla of Navy vessels in the area. His threats to take over Greenland. Then he threatened the EU countries with more tariffs if they opposed him taking over Greenland. And then he walks back all of those threats. Now he's threatening Carney with 100% tariff on Canadian goods if Canada works a trade deal with China. And so I think that the markets are really getting very weary of all Trump's rhetoric. They got the term Taco Trump. Trump always chickens out. And that's his thing. He makes a threat, he backs it off, and on it goes. And I think we're starting to see that the foreign investors, the ones who have jumped into the tech stocks and get in on that AI train, they're starting to get tired of Trump's rhetoric. And I think they're starting to really consider, do they want to have all their money invested in the U.S.? And I would not be surprised to see the markets lower here. I just saw a report from Citadel Securities, and what this report shows that the retail investors' risk-on sentiment is now 99%. And that's the highest level it's been since last October, and it represents a huge pivot away from the April Liberation Day lows. So we're seeing earnings coming in higher than expectation, yet the markets haven't reacted positively. And when that happens, that typically suggests that the markets are priced to perfection, and that suggests a pullback here would not be out of the question, and certainly at least in the short term. So you got the S&P 500 is now at 69.38. The 100-day moving average is 67.82, so that would be about another 50 points down. The 200-day moving average, though, is about 64.50, and that's a very strong support area. So, that could be where this thing ends up. I saw a very interesting chart the other day, and it showed the return of the S&P 500 versus inflation over the last 50 years. And it's just something for people to keep in mind. So, markets, there's always going to be corrections, and some of them are going to be very severe. And if we get a nice correction here, again, that's a good buying opportunity, because over time, investing in stocks, it protects your purchasing power and it trounces inflation. Here are the numbers that were on that chart. So in the last 50 years, inflation is up 460%. The S&P 500 dividends are up 2,000%. The S&P 500 total return, so that's the movement of the stocks plus dividends, is up, get this, 29,000%. So inflation's up 460%. The total return is 29,000%. So, people are worried about inflation over the long term. Stocks are going to beat it.
With currencies, the U.S. dollar recently hit a 4-year low. What do you see ahead for the U.S. and Canadian dollars?
Well, yeah, with currencies, I always say this because it's true. It's all connected. When the U.S. dollar goes up, other currencies go down. When the U.S. dollar goes down, the other ones go up. And we're just seeing that today. The U.S. dollar this week had been weak. All the other currencies were up. Today, the U.S. dollar is up. Everything else is down. So when you're looking at the U.S. dollar, like I say, it's been taking a beating for the last week or so. I said a year ago that when Trump got elected, he wanted a lower U.S. dollar. And we saw these other commentators saying, because they were talking that they didn't want that, they wanted a strong dollar. But that's not what he wants. This week, we actually heard him tell the truth. And when they said that, what is he worried about the dying dollar here? And he thought the U.S. dollar was doing great. The other day, and just after he said the dollar was doing great, Secretary Treasurer Bessent, he stated on Wednesday, the strong dollar policy is completely intact. We want a strong dollar, which is total BS. Because if you remember during the election, Trump constantly harped that the Asian countries were keeping their currencies too low because they wanted to make their exports cheaper for the Asian producers. And now we've got the Trump administration wanting to do the same thing. They want the dollar lower. Because a weaker dollar, that acts as automatic discount for American products. So right now, since Trump got elected, so since he took office in January a year ago, the U.S. dollar is down over 13%. So that means for a company like Caterpillar, if the U.S. dollar drops, say, another 7%, so let's say the U.S. dollar gets down to about 20% decline. That means for Caterpillar, their tractors cost 20% less for foreign buyers. And then think of a company like Boeing. Their aircraft basically, I'm sure they're the most expensive products the U.S. exports. Well, think of a 20% decline in the U.S. dollar. That would make save a foreign airline, millions of dollars on a single airplane. And, and it's not just about exports that Trump wants to tackle here. He also wants lower interest rates because that would put pressure on the U.S. dollar. And one of the key reasons that he wants lower interest rates is because he wants to keep running up large deficit. He wants to keep spending. As we just talked about, the total U.S. debt is $39 trillion. The U.S. is already paying over $1 trillion every year to pay the interest on their debt. So lower interest rates would mean less service costs on their debt. And again, understand Trump has no intention of reducing government debt. He wants big spending policies. Now, there is risk to having the U.S. dollar get too cheap. I mean, if the U.S. dollar does drop 20%, well, that means U.S. consumers are going to pay, 20% more for imported goods. And, 40% of what Americans buy are imported goods. The other big one is that foreign central banks will stop buying U.S. treasuries because the U.S. dollar is weakening, and that means the return is less. And again, as we just mentioned, already we're seeing, China's already reducing their treasury holdings. So if there's fewer buyers of U.S. debt, then the interest rates would actually rise, even if the Fed cuts rates, because those are just short-term rates. So The weaker the U.S. dollar is one of the main reasons we're seeing the precious metals on such a wild bull run. And it's one of the reasons we're seeing such a sell-off today in precious metals, because the markets are concerned that the new Fed chair is not going to be as accommodating as they expected, meaning that the U.S. dollar may stay higher than the markets were expecting. So now, as for the Canadian's been on a real roll recently. It was up over 74 cents yesterday. Well, it's down today again because the U.S. dollar is stronger today. So the Canadian dollar is up about 7% since Trump took over. Again, all because of the U.S. dollar weakness. Also, Canadian dollar has done well with the Bank of Canada holding rates steady, and that's narrowed the yield gap with the U.S. yields. So, and another thing, of course, is that the boom in commodities lately. Canada is a large producer of precious metals, copper, base metals, uranium, and they've all been on a big run lately. You got energy prices have been rising. You know, oil's been up in the last few weeks. That's all good for Canadian producers. So despite Trump's constant railing against Carney in Canada, there really has been relatively, small or low trade barriers. And the U.S., between U.S. and Canada, and that's helped the trade balance for Canada. Now, while Trump has imposed tariffs on certain sectors for Canada, over 90% of Canadian exports to the U.S. are compliant under the CUSMA trade agreement. Now, of course, negotiations to that agreement start up again in June, so I'm sure we're going to get a lot more noise and tensions again then. But as I say, it's all connected, heavily driven by what happens in the U.S. dollar. If the new chair does cut rates and other central banks hold steady, then you're going to see the U.S. dollar pull back, and then you're going to likely see the Canadian dollar, the euro, the yen, and most other currencies start to rise.
What do you see ahead for oil this year?
Well, the oil story is it's interesting. I think we talked about it last month. It's really a story of two worlds. You've got the price of oil, so the raw stuff, but then you've got the business of oil, which is booming. So the price of oil, it hit multi-year low at $54.90 in mid-December, and that around $55 support level is now held 4 times. So it first hit it in April, then again in May, tested it again in October, and then about 4 weeks ago. But since then, so in the last few weeks, the oil price has been rising. Currently, we now are at about, 65.60. So, we've called for rising oil prices, especially for the later half of 2026. We've got a lot of geopolitical tensions right now. As I mentioned earlier, the U.S. has got their flotilla of naval vessels just out the Strait of Hormuz. Trump warning Iran that time is running out, to make a new nuclear deal. He's also threatened a potential regime change, saying that that's on the table if Iran doesn't, if the Iranian government continues to be violent crackdowns on its own citizens protesting the regime. So in addition to all this geopolitical talk, of course, you've got the weather issues back east. You got that extreme cold weather in the east and Midwest, and even all the way down to Texas. And that's caused a major production shut-in for both oil and gas producers. And of course, so that means limiting supply. So limiting supply, demand is still going up. So you got the supply to demand cycle there. And that cold weather is again expected to continue next week. So even with the low prices in oil over the last year, the stocks have done very well. We already own many oil stocks, and we expect 2026 to be a really good year to invest in oil.
What's happening with Bitcoin?
Well, not much. Bitcoin has really done nothing lately. It's formed a head and shoulder pattern. Now, obviously, I can't show that right here. But basically, it means that you get a high, and it sells off, and then you get a higher high. So the first high is the left shoulder. Then you get a higher high, and that's the head, and then it sells off again, and then you get another high, but it's not as high as the middle one. So you get these two sort of lower highs, and lower highs, lower lows in any trend line. That's a time to think about, time to worry a bit. So when you get the neckline, so now if you visualize those three highs, the neckline would be kind of like the armpits of those two, in between those two shoulders. And if that neckline gets broken, so that means that the market goes below that neckline, that's usually a cause of worry. Well, for Bitcoin, that neckline was just broken this week. So the net line was about 84,000. Today, Bitcoin's at about, and what we got, 83,200. So, it could bounce back up and things are okay again. But if it continues lower, that could be trouble for Bitcoin for the near term. So again, Bitcoin was supposed to be the digital gold, but for most of 2025, it's been trading more closely with the NASDAQ Tech Index. And while gold and the NASDAQ have been trading all-time highs lately, Bitcoin's, we're sitting at about 83,000, and that's about 35% off its all-time high. So it's not keeping track. So the real question for Bitcoin to me is, what is it? Is it a risk asset? Is it a digital gold? And I think that when the Bitcoin ETFs came on board, that really boosted Bitcoin's price. But when gold and silver on such a tear, I think many of those holders of the Bitcoin ETFs, they sold that and they poured into the AI play and the gold and silver bull run. So now Bitcoin's trying to figure out what its place is. So I think that that debasement trade is where Bitcoin ultimately will find its footing. Bitcoin does have a mathematical fixed supply of 21 million. So in a world of skyrocketing national debts, Bitcoin could act like a digital land, thinking that they're not making any more of it. And that would make it kind of a natural shelter where currencies keep losing their value. So long term, I think Bitcoin will find its way, but in the short term, it's definitely struggling here. The next support for Bitcoin on our stats is now about 73,000 down to about 68,000. So that's a range that we've got triggered for that. And if we do see Bitcoin drop down to that range, and if it holds, I think you're going to have a nice buying opportunity.
You're a big supporter of decentralized finance, DeFi. Can you tell us a bit about that?
On DeFi?
Yes.
Sure. Well, as you say, it's decentralized finance. Basically, you're thinking of blockchain, right? So you're thinking about all of the transactions that used to go through banks and intermediaries. Well, now you have the opportunity to remove those intermediaries and to do peer-to-peer transactions. And that opens up a whole new world of transaction. And we're talking about things like, it could be real estate, it could be commodities, it could be debt, it could be bonds, it could be mortgages, where individuals could be lending other individuals as a mortgage. One of the great examples we used to use is, think of a warehouse today that's worth, say, $20 million. And right now today, who could buy that warehouse? Well, you'd have to have a pretty deep pockets to buy it. But in the world of DeFi, you could tokenize that. You could break that down into smaller pieces. So think about if you and I want to invest in that warehouse, and say you got $10,000 you want to invest, you could buy a piece of the warehouse. And so could millions and millions of other people around the world. And so what it does is it opens up, for the person trying to sell the warehouse, it opens up a whole new world of buyers who normally wouldn't be able to even bid on it. And we're seeing artwork that can be done. You can see paintings where people can buy a piece of a famous painting. We've actually seen racehorses where people could buy a portion of the racehorse. And we've seen it in real estate. A great example is some properties in Florida. These are vacation properties. People could buy in, so you could say you invest your $10,000, and then you get a piece of, your percentage of the revenue that home generates. Just like basically it's like dividends in a stock. And it just gives you this kind of new world of being able to transact, again, to remove those intermediaries like banks, and thinking like in lawyers, because you've got smart contracts now that can handle so many different types of transactions. This is very early innings here. It's definitely for people that, have an idea that they like getting in on the very early things. I mean, think of Bitcoin 15 years ago. It's the same kind of action here. Most people are like, what is this? I don't want anything to do with it. But those who followed through with it and dipped their toes in, I think of Bitcoin when it was first a couple $100, and, recently it was 124,000. I think you're going to see that as these things start to develop, those who want to dip their toe in, again, it's very speculative right now, but if you wanted to get your toe into it, we do have our DeFi Digest. It's free right now. If you want to get in on that, just simply send us a note at info@thetrendletter.com, and we'll put you on the list for the next issue.
Martin, thank you so much for being on This Week in Money.
Always a pleasure, Jim. Thanks a lot.
My guest has been Martin Straith, founder of Trend News online at thetrendletter.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Victor Adair, and Martin Straith. And thank you for listening. If you have any questions for the show or for any of our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.